Welcome back to Trinidad and Tobago. And as you know, last week, Friday, the Minister of Finance delivered the mid-year budget review. A lot of expectations. The Minister hinged a lot on the plans for the rest of 2020 into 2021, predicting a 4.7% growth rate. In addition to that, he's saying that the deficit originally, which was put at $15 billion, is now down to $14 billion. As you remember, initially it was supposed to be $8 billion. All of these figures are now just to tell you that he's hoping to have a better 2020 and 2021. A lot of people were surprised by these predictions, but maybe Sarodh will have some more. Maybe Sarodh will share the optimism this morning. I see him there smiling through it. I hope you have some good news, because when I had a show on Friday night, my guests were not very excited about the minister's predictions. Good morning. I hope you had a wonderful weekend. What do you have for us this morning?
Good morning, Hima, and good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, certainly it was a very interesting mid-year review. Perhaps a bit more optimistic than most would have expected. And certainly we are, well, actually today our presentation is not based on the mid-year review. It will be next week, and we're going to go through with a fine-tooth comb some of those projections and do some reality checks and testing before we put forward a more formal position on that review for the viewing public and investors in Trinidad and Tobago. But today we're taking a look at the bank, some of the Canadian origin banks in the banking sector of the Trinidad and Tobago Stock Exchange. And of course, we're talking about Scotiabank, Trinidad and Tobago, as well as FirstCaribbean International Bank. And they would have recently released their second quarter results. Not very good reading, but it was expected to some degree. So let's take a look at what those results look like. And we'll firstly look at Scotia, and for that half-year period ended in 2020, well, half year 2020, the group reported an earnings per share figure of just around $1.49 per share, which was a pretty substantial decrease from the $1.94 recorded in the prior comparable period. Now, net interest income and total revenues, importantly, they did hold up fairly well, fairly stable. Total revenues were actually down just around 0.5%, so pretty stable in the context of what's going on with respect to COVID. And a slower or more muted economic activity. Non-interest expenses, however, did climb just around 6.7% from $378 million to $403 million. And overall, higher credit provisions, as well as those higher non-interest expenses, would have led to a decline in income before tax of 15.9% and a decline in income after tax of just around 23.6%, falling from $342 million to just around $262 million. Now, when we take a look historically at Scotiabank's revenue composition, we can see that while the trend had been positive, it was slowing down over the past few comparable periods, and we can see in 2016, total revenues grew by just around 12%. In 2019, that had fallen to just around 2%. And in the fiscal half year 2020, that has now turned negative, just about 0.5% decline, as mentioned. No major changes in terms of composition. Net interest income actually continued to grow in that red column from $650 to $664 million, and other income actually declined from $261 to $251 million as Scotia embarked on some waiving of fees to alleviate some of the economic pressures to some of its clients coming out or arising from COVID-19. Now, at a price of just around $54.50, the group would have declared a second interim dividend of 40 cents per share, which is actually 20% lower than its prior second interim dividend of 50 cents per share. So again, taking some prudence, preserving some cash, but the stock is trading at a dividend yield of 5.5%, which is above the banking sector average of 3.6%. And a PE ratio of 16.4 times, which appears on the face of it to be well below the 22 times of the banking sector itself, and may give investors some impression that there is some attractive value there for Scotiabank in particular. But again, with most of the banking sector's earnings declining, and in fact, as we look at FirstCaribbean, that would have swung from a profit to a loss, it would skew or actually play some games with some of those valuation levels. So we are maintaining our neutral rating on Scotiabank at this particular point in time. Bear in mind also, there was the much touted acquisition of Scotia's insurance operations by Sagicor way back in November of 2018 or thereabouts. That still hasn't come to fruition, and there is apparently a drop dead date of June 30th, unless otherwise extended, for that deal to go through. No news on that just yet. Turning quickly to FirstCaribbean International, and as mentioned, the banking group would have swung from a profit of 30 cents per share in the half year of 2019 to a loss of 25 cents per share, or 182% change in that earnings per share figure. So quite a very substantial change in revenue, in earnings per share. Total revenues, again, like Scotia, was fairly stable, just down 1.3% from 2.04 billion to just around 2.02 billion. Operating expenses marginally higher by 3.7% from 1.32 billion to 1.37 billion. The big changes, of course, were in that credit loss expense, and that would have skyrocketed from just around 3.5 million TT equivalent in the half year of 2019 to over 700 million in the most recently concluded period. So certainly, it creates an impression of what the bank is looking forward to in terms of deteriorating credit conditions and probably taking a bit more impairments or credit loss expenses than they may need to, but certainly a very prudent approach, which should be commended in the particular environment, but it doesn't make a very pretty reading for investors. Now that overall, the loss for the period, 390 million TT equivalent, which was in stark comparison to that profit of about 490 odd million in the prior comparable period. Now, total revenues by segment seem to be fairly stable, as mentioned. There was a modest decline in net interest income from 1.4 billion in the half year of 2019 to 1.38 billion in the half year of 2020, and other operating income remained fairly consistent at around 637 odd million TT equivalent. Of course, there was some quite significant one-off expenses. Firstly, that very significant jump in credit loss expenses by about 700 odd million. And secondly, there was a goodwill impairment charge, which is a non-cash charge. So it's not actually cash being paid out, but it is a decrease in the value received for investors. And that was manifested in the group's profit before tax by segment figures. So corporate and investment banking, PBT would have almost halved from 401 to 207 million. Wealth management came down modestly from 99 to 83 million in the context of things. And the retail and business banking segment actually fell the most, from a profit of 219 million in the half year of 2019 to a loss of 186 million in the half year of 2020. So some big changes by way of results for FirstCaribbean International. Investors, however, haven't seemed too phased, with the stock trading fairly steadily at $7.25. And at that price, it's trading at a price to earnings ratio of 47.1 times, which is very, very much above that banking sector average, again, which might be slightly elevated, particularly because of FirstCaribbean, to 22 times. The stock does, however, pay a dividend yield of 4.6%, which is above the banking sector of 3.6%. And importantly for investors, particularly in these times, it pays its dividends in US dollars. So maybe that's why the stock price is holding some of its value. Nevertheless, it is pretty high in terms of valuations. And that COVID-19 impact, not just for FirstCaribbean, but for pretty much all of the stocks listed on the stock exchange, is going to have a material impact on performance, not just for the second quarter, but perhaps for the next 1 or 2 quarters in particular. So at this current valuations and price, Bourse maintains its neutral rating on FirstCaribbean International. Well, that's it for this week's report. For more information, you can contact us at 226-8773. Check out our website at bourseinvestment.com, or you can email us at invest@boursefinancial.com. Now look out next week for a presentation which covers the mid-year review and takes a reality check on some of those figures. That's it for this week, Hema. It's back to you. Have a great investing week. This has been the Bourse Report.